our knowledge series on corporate tax in UAE. In this video you will learn about the business restructuring relief. This video covers the following important matters of business restructuring relief. Eligibility for business restructuring relief. Requirement for consideration proceeds received from business restructuring. Conditions for parties in business restructuring. Ownership interest. Conditions for restructuring relief. Effects of transfers on restructuring. Election to apply business restructuring relief. Clawback rules. Introduction. Restructuring of business can take various forms. For the small business, it might be a transfer of sole proprietorship business to a company and continuing business through it. For large companies, it might be the purchase and sale of subsidiaries either within the UAE or a part of a multinational conglomerate. Examples of restructuring. Incorporation. A sole proprietor or partner transfers their business to a new company in exchange for shares in that company. Merger. Two or more companies combine into a single company. Demerger. Companies separate out. Spin-off. Company transfers one separable part of its business into another unrelated company. Takeover or acquisition. Business is acquired by another entity. Hive down. Company moves its business, or part of it, into another related company. Any restructuring will involve an exchange or issue of shares and at least a partial change in ownership of a business. Transfers eligible for business restructuring relief, resulting in no gain no loss. Transfer of assets between two independent companies will arise either a net gain or a net loss for the seller. However, under Article 27 Clause 1 of the Corporate Tax Law, where the following conditions are met, restructuring relief will apply. Taxable person transfers its entire business, or an independent part of its business, to another person who is a taxable person or will become a taxable person as a result of the transfer, and the transfer is made in exchange for shares or other ownership interest of the transferee. Or, one or more taxable persons transfer their entire business to another person who is a taxable person or will become a taxable person as a result of the transfer. The transfer is made in exchange for shares or other ownership interest of the transferee. The transfer will cease to exist as a result of the transfer. Consideration. Consideration may be received in the form of cash and in kind. However, under Article 2 of Ministerial Decision No. 133 of 2023 on Business Restructuring Relief, for a business restructuring relief to apply, market value of the non-shares or ownership interest consideration must not exceed the lower of net book value of the assets and liabilities transferred, or 10% of the nominal value of the ownership interests issued. Illustration. Cash consideration. FLLC, a UAE-based company, is purchasing KLLC, another UAE-based company. As part of this, FLLC will receive 100% of the shares in KLLC in cash consideration of AED 1 million. KLLC is valued at AED 10 million, has total net assets with a total net book value of AED 1 million, and issued share capital with a nominal value of AED 5 million. To be eligible for business restructuring relief, the cash or non-shares consideration received must not be more than the lower of net book value of the assets and liabilities transferred, that is AED 1 million, or 10% of the nominal value of the ownership interests issued, as FLLC will own 100% of the shares, so this must be KLLC's issued share capital of AED 5 million, that is AED 0.5 million. As the cash received of AED 1 million is more than AED 0.5 million, the lower of the above two figures, business restructuring relief cannot apply. Parties to the transfer. Under Article 27 Clause 4 of the Corporate Tax Law, relief will still apply when the ownership interest in the business is transferred by or to a different party under the agreement, if the following conditions are met as per Article 6 of Ministerial Decision No. 133 of 2023. Shares or ownership interest must be received by a person who has a direct or indirect ownership interest of at least 50% in the transferor. Shares or other ownership interest must be issued by a person that has a direct or indirect ownership interest of at least 50% in the transferee. As per Article 7 of Ministerial Decision No. 133 of 2023, where an application for relief has been made by an unincorporated partnership to be treated as a taxable person, No gain or loss needs to be taken into account in determining taxable income irrespective of whether any shares or ownership interests are received by the partners in the unincorporated partnership or whether all partners in the unincorporated partnership are taxable persons. Ownership interest. Under Article 3 Clause 1 of Ministerial Decision No. 133 of 2023, an ownership interest shall include, but not be limited to, holding any one or a combination of the following instruments: ordinary shares, preference shares, redeemable shares, membership and partner interests, other types of securities, capital contributions, and rights that entitle the owner to receive profits and liquidation proceeds. Article 3 Clause 2 of Ministerial Decision No. 133 of 2023 mentions, to qualify as an ownership interest it must also be treated as an equity interest under the accounting standards applied by the taxable person holding the ownership interest. Article 3 Clause 3 of Ministerial Decision No. 133 of 2023 states, a taxable person is treated as holding an ownership interest where the ownership interest is controlled by the taxable person and the taxable person has the right to the economic benefits produced by the ownership interest under the accounting standards applied by the taxable person. Conditions for restructuring relief. Under Article 27 Clause 2 of the Corporate Tax Law, conditions for relief to apply are as follows. Transfer meets all the conditions imposed by the applicable UAE legislation. Each of the taxable persons is either a UAE resident or has a UAE permanent establishment. None of the persons are exempt from corporate tax. None of the persons are a qualifying free zone person. Taxable persons use the same accounting date. Taxable persons use the same accounting standards. Transfer is undertaken for valid commercial or other non-fiscal reasons which reflect economic reality. This prevents companies benefiting from relief by making artificial arrangements with the intention only of avoiding tax. Transfers on restructuring. Under Article 27 Clause 3 of the Corporate Tax Law, where business restructuring relief is applied, it will have the following effects. Assets and liabilities transferred shall be treated as being transferred at their net book value at the time of transfer so that neither a gain nor a loss arises. Where transfer does not cease to exist as a result of transfer, the value of the shares or ownership interests received in the restructuring shall not exceed the net book value of the assets transferred and liabilities assumed, less the value of any other form of consideration received. Where transfer ceases to exist as a result of transfer, the value of the shares or ownership interests received in the restructuring shall not exceed the book value of the shares or ownership interests surrendered, less the value of any other form of consideration received. Any unutilized tax losses incurred by the transferor prior to the tax period in which the transfer is completed may become a carried forward tax losses of transferee. Article 27 Clause 5 of the Corporate Tax Law states, where an independent part of a business is being transferred, any unutilized tax losses transferred with it must be reasonably attributable to that part of the business. Under Article 5 of Ministerial Decision No. 133 of 2023, unutilized tax losses can be carried forward to transferee when it continues to conduct the same or a similar business or business activity that was conducted by the transferor prior to the transfer. Relevant factors to consider in this regard include: transferee uses same or all of the same assets that were used by the transferor prior to the transfer. Transferee has not made significant changes to the core identity or operations of the business since the transfer, and, where there have been any changes, these result from the development or exploitation of assets, services, processes, products, or methods that existed before the transfer. Election to apply business restructuring relief. As per Article 4, Clause 1 of Ministerial Decision No. 133 of 2023, an election must be made by the transferor for business restructuring relief to apply to a transfer, in the form and manner as prescribed by the FTA, and the transferor and transferee must maintain appropriate records. According to Article 9 of Ministerial Decision No. 133 of 2023, both the transferor and the transferee must maintain a record of the agreement to transfer the business or the independent part of the business at the value prescribed. They must also keep suitable records to demonstrate that they have met the requirements to make any adjustments prescribed by Article 5 of Ministerial Decision No. 134 of 2023 on the general rules for determining taxable income. Details of these requirements for the adjustments are covered in video number 7 of our Corporate Tax Knowledge series. Clawback rules. According to Article 27 Clause 6 of the Corporate Tax Law, business restructuring relief will not apply where, within 2 years from the date of transfer, any of the following occurs. Part or all of the share or ownership interest in taxable person, that is the transferor or the transferee, is disposed to a person that is not a member of qualifying group to which the relevant taxable persons belongs. Subsequent transfer of the business or independent part of business which was transferred. Article 27 Clause 7 of the Corporate Tax Law and Article 8 Clause 1 of Ministerial Decision No. 133 of 2023 states, where a clawback charge is triggered, the gain or loss that would have arisen on the initial transfer must be calculated and included in the transferor company's tax return in the tax period in which the charge is triggered. Article 8 Clause 2 and 3 of Ministerial Decision No. 133 of 2023 mentions, if the transferor has ceased to be a taxable person or the transferor is a natural person, the clawback charge is levied on the transferee instead of the transferor in the tax period in which the charge is triggered. Under Article 8 Clause 4 of Ministerial Decision No. 133 of 2023, when a clawback charge is triggered, transferee must make any necessary adjustments to its taxable income in the relevant tax period in which the clawback charge is triggered to reverse any depreciation, amortization, or other change in the value of an asset or liability that has been previously adjusted by the transferee for this transfer subject to the Article 5 of Ministerial Decision No. 134 of 2023 on the general rules for determining taxable income, and relevant provisions of Article 5 of Ministerial Decision No. 134 of 2023 no longer apply in relation to this transfer. This ends our video session. Subscribe to our channel, and click on notification icon to stay tuned to the series of valuable material that will cover all aspects of the UAE corporate tax. Our partner is available for free consultation who is holder of FTA-approved UAE corporate tax qualification. His contact details are provided here. Visit finexcel.ae. Navigate to our clients and testimonials webpage to see more clients' review on our services and our major clientele. Contact us for more detail. FinExcel. We create value that matters.